Today's live stream. Super excited. We're going to kick things off with an amazing panel here. We've got, of course, Evan from Stock Market News, who co-hosts these with me, as well as Adam Patty, the CEO over at Vista Shares, and Tony Dong, lead ETF writer and analyst for ETF Central, here today. Going to talk about the market initially, share a couple of thoughts. Are we getting a little frothy? Earnings are coming up. And then we're going to rotate into some great ETF discussions, touching on some of the income style products as well as some AI products. Let's get right into things. Adam, appreciate you coming back on as always. What's your thoughts on this market, which just continues to push all-time highs?
Yeah, well, thanks for having me. It's great to be back. I mean, it's an interesting market, right? I mean, the tech names keep powering forward, getting me a little bit concerned on some of the big name, the Mag 7 and some of those others, because, they came roaring out of the tariff tantrums and have not looked back. We've been in a momentum driven market for years, and I was convinced we were going to rotate out of momentum into some other factor tilt, and it just continued right out of the tariffs. So, I think it's time for investors just to be a little cautious. And I wouldn't change your plan. Don't sell out of anything. Don't do anything crazy. But just, be cognizant of your diversification of your portfolio and make sure you own some names that, maybe have been out of favor for a little bit of time.
Yeah, stay open to different ideas. Tony, how about you? What's your thoughts on this market?
There's not a lot of breadth across the market. I agree with everything Adam says. Mag 7 are still carrying the market as a whole, and equal weight continues to lag. I am a bit concerned about valuations. We've seen a lot of discussion about the Buffett indicator. And while that has changed, given, how much the market has changed since the 1980s, there's no denying that it's running very hot at about 200% of GDP when it comes to stock market capitalization. If you look at other metrics like Shiller PE, which is the cyclically adjusted PE ratio, we are currently higher than what it was after the COVID boom, with the only highest time after this being December 1999, which, as we all know, is the dot-com bubble. So, at this point, I'm not really keen on the indices, especially the market cap weighted ones. I think there's a lot of merit in individual names that are perhaps falling out of favor. And this earnings season, we've already seen a few. Lockheed Martin's down 9% today. I think they missed guidance on something. So, as we head into earnings seasons, keep your eyes out. Lots of opportunities.
What do you think about situations like we saw yesterday, where there was a sell-off in some of the higher beta names like Robinhood and Palantir, and a rotation into Google and Apple?
It's a flight to quality. I see it today with Berkshire Hathaway up. Honestly, on like a day-to-day scale like that, it's just noise, right? But longer term, valuations do matter, and I don't think in any scenario paying 100 times forward earnings for a tech name is going to work out for you long term. Perhaps short term it will, and as we all know, animal spirits are currently very much in season right now. It's the summer of 2021. My barometer for this is Cathie Wood. Actually, if I look at ARK and it's doing what it looks like it was doing in 2021, well, that's kind of where we're headed, in my opinion.
Yeah, I agree. I mean, look, Apple was out of favor for quite some time. Maybe a little bit of headwind on their AI plans, and of course, Google, has been lagging a bit. But to Tony's point, I mean, some of these other names have just gone straight back up and exceeded prior highs. So, I think the bigger names, the Apple. I mean, I did just take a negative outlook on the Mag 7, but I should have been a little more specific. I mean, a name like Google or an Apple certainly has not seen the run up that some of the others have.
Understood. Evan, you want to weigh in here? Any thoughts or questions?
Yeah, well, listen, we're hanging out around all-time highs, so there's only so much bearish you could say about it. It feels like we're definitely there was euphoria for a couple weeks, and now maybe some of these bigger names feel like maybe we're just waiting for earnings here. But under the hood, there are these meme stuff going on. Kohl's randomly was up like 20% this morning and then came, or like a 2x. I don't know if you guys watched Kohl's this morning. That was a little bit of a wild move. So I'm definitely starting to see some of those 2021 trends. I can't lie. I might have tried to get some shares in the Figma IPO simply on, hey guys, it's 2021. This is the silly season is here. We'll see. But in this time, I am still buying some names that I can find that I think have good values on them. And Apple was one that I've been trading around a little bit, and Google as well, as they've been playing the catch up. The market has definitely remained strong. I know maybe at times it feels like it's narrow leadership, but that narrow leadership is is being passed along as well. So, and it feels like it has been expanding out. So, I think this has remained a bullish market that might be taking a little breath at all-time highs. That, truthfully, I feel like is about to continue higher. We'll see.
Adam, you got thoughts on that?
No, I agree. I always just come back to making sure you have a diversified portfolio, because, we could talk all we want, and, you guys have great points, and, my points may not be as good as yours, but, we just don't know. We don't know what's going to happen. There could be a geopolitical shock next week. We've got the tariff stuff coming back in a couple of weeks, right? With the deadlines, what's the EU going to do? China might be delayed now. So there's just a lot of stuff going on. And traditionally in August, you got lower volume, so a little bit more volatile, potentially more volatility with the lower volume. So stick to your plan, be diversified, and as Evan said, pick some names you like, and leg into them if the valuations are correct, as far as you're concerned.
Got it. Tony, any other thoughts? Oh yeah, go for it, Evan.
Yeah, one thing I was just gonna say, we're gonna talk. Obviously, Adam has some great products out there. One of them that we've been watching, OMAH, and obviously Buffett has a nice diversified portfolio in there. So even those type of names like Coca-Cola, American Express, Apple, Bank of America, Chevron, it seems like in this broadening out basket, those might be some names that continue to be winners.
Yeah, for sure. Before we dive into the ETF side of things, Tony, any other thoughts on the all-time highs that we're seeing, and then the earnings season that we're about to really get into the thick of?
This is going to be an unpredictable one. I'm expecting higher than volatility compared to other earnings seasons. Adam touched on this briefly. The geopolitical events are a concern. We've seen President Trump go at it with Fed Chair Jerome Powell, and obviously the ongoing situation in the U.S. warrants watching, I think. It's already affected the healthcare sector. We've seen United Health be in the crosshairs. We've seen some pharmaceuticals be in the crosshairs. And you guys got to remember, there's another 3 years of this to go. So, as Adam says, stay diversified, avoid piling into single names. And I would personally, something I'm looking at are increase my allocation to the defensive sectors. So staples, utilities, and healthcare, especially healthcare, is very battered right now, lower than average valuations.
Interesting.
Yeah, so definitely the IPOs, like Evan mentioned, has been very hot this year. Market all-time highs, and ETFs have really had a record year for inflows and people continuing to create and distribute them. One of the types of ETFs that has really taken the market by a storm, and retail investors specifically, are these income-focused ETFs. Adam, you mentioned, was it just in OMAH, another 50 million in AUM has come in the past week?
The past day and a half. I mean, it's
day and a half.
Yeah, I mean, we're very, very fortunate. It's a great product. I mean, QUSA has seen it pop up in volume as well. So we'll get some creation units today or tomorrow on that. But yeah, I mean, look, investors, particularly in times like now, want some stability in their portfolios. They should be looking for names that they don't necessarily own, or certainly aren't over concentrated in. And, most investors are now, coming to grips with the fact that the S&P 500 and the Qs, there's, it's Mag 7, right? It's a lot of over concentration in some of these big tech names that have had a huge run. I mean, they had a huge run before the tariff tantrums, and they certainly came out of that period and had a run again. So, I think it's time to, look for other opportunities to try to get into some names that you might not own, and certainly aren't over concentrated in. And then if you could have the income opportunity layered on top of that to, give yourself a target, 15% a year, 1.25% per month, kind of stable, consistent earnings growth while you get some capital appreciation, I think investors are just taking note of that.
100%. That has been a big thing that's pulled people in. I think what is successfully happened here with OMA, and then I really want to get Tony's insights on this as well, is I think for retail, this is connecting two sides of the puzzle. One, stability of the Berkshire name, right, and the Berkshire holdings that are coming with it. And people can look at that and see track record, because obviously for ETFs, new ETFs, it's hard, right? You don't have a track record to show people, hey, we've outperformed over this time period, or, we've made good picks. But people can look back at Berkshire. The number two, you're offering them that income that people have just become, absolute fiends for in this market. And specifically, I think you're giving them a target income as well, right? Not saying, hey, we're just trying to maximize this as much as possible, or 10%, right? But rather looking at that 15%, which of course I think is appealing to people because typically they've looked at the markets and say, hey, we're going to average 8 to 12% somewhere in there on SPY. Here's an opportunity for something that has the Berkshire name, also has distribution rate of 15%. So I think it gives comfort to people in multiple areas. Is there any other things before I go over to Tony, Adam, that you see on the timeline, people talking about or questions that you get around OMH?
Well, I think it comes to the holdings again, right? I mean, if you look at the holdings, I mean, yes, you have Berkshire B in there, obviously. You have Apple, which is our largest holding now. But then you go down the list, and there's companies in there that most people just simply don't own. And may not even have heard of, but they are top picks of Warren Buffett, so they have that value tilt, and I think investors are looking for that. And to be honest, what I'm surprised about, I was convinced we were going into a value tilted and quality tilted market, after the tariff tantrums. Then, of course, I was wrong, went right back into a momentum driven market. But again, it's going to have to change. These factor tilts, value, quality, volatility, and things like that, they don't last forever. They have finite periods of time. And we have been in a clear momentum market for so long. And it's benefited people, right? Their asset values are increasing. They're feeling rich. They have strong portfolios. But now is the time to be smart and try to bring in some names or funds that have the names that you don't own, and be ready for that kind of more volatile period of time where there might be a drawdown in kind of the traditional tech names, the momentum driven names.
Yeah, that's a good point as well, right? I think this is an area of the market where if we do see a big pullback, it'll be a little bit more controlled in a name like this. Tony, would love to turn the mic over to you and just hear kind of your full rundown and thoughts when you look at ETFs in this manner.
So OMA is a very interesting one. When you buy Berkshire, people think that you just get exposure to the public equities portfolio like Apple, Chevron, but you actually get ownership of a portfolio of wholly owned businesses, things like Geico, BNSF, and of course you get that unique Berkshire flywheel model where they invest in insurance float and they allocate capital intelligently. But if you just wanted to isolate the public securities portfolio and bet on Buffett's, or more correctly, Aditya's skills as a stock picker moving on, well, you kind of had to go assemble it yourself, which was an inconvenience. There's also the fact that Berkshire itself doesn't pay dividends. Buffett does it on purpose for tax efficiency. But if you want income, the only solution before OMA was you would buy 100 shares of Berkshire and then you would sell a covered call. So at today's price, that you would need about $47,000 of capital. And of course, you'd have to manage, what expiries you want, what strikes you want, roll the contracts and so forth. And you might not get that same target level of income you're hoping for, depending on changes in volatility and such. With OMA, that's just your income solution right there. And I think it's a very refreshing change from the cover call ETFs I see, where they're usually just pegged to the S&P 500, the NASDAQ 100, and so on. You're getting differentiated exposure here. The active share is high versus most of the benchmark indices. And even in the top 10 holdings, I see names that I wouldn't, like VeriSign. Like, not a lot of people know them, but they run the internet infrastructure. That is a crazy strong moat there in a smaller name that if you just bought a market cap weighted index, you wouldn't have exposure to, but it's one of Berkshire and Buffett's longest holdings. So I think the inflows speak for themselves. Like usually income products, I see them struggle, but especially, if they're not from like JP Morgan or Global X or someone with all those marketing dollars. But OMA, just through, I think, intelligent portfolio construction and filling a unfulfilled need in the market, has over 300 million now within a few months. It's phenomenal.
Yeah, thank you.
Tony, when you look at these, you've outlined a lot of the pros to the upside. If you were to go in and write a research paper on something like this, to give retail more information, what would you really focus in on? Where are the areas where you're like, I'd really like to flesh this out, give people a few pages of my thoughts?
Definitely the tax efficiency. So for income ETFs, it can vary. For instance, JEPI is very popular, but it's actually incredibly tax inefficient because it uses equity linked notes, and a lot of that is taxed as ordinary income. I'm looking at OMA's recent distribution calendar, and you can see a return of capital makes up a fair amount of the distribution. Now, this is a target income ETF. We're aiming for a 15% distribution over a calendar year. So this is totally normal. And I think for some investors, especially if you're focused on income, return of capital is fine. It lowers your cost basis, right? You defer capital gains until you want to sell. And if you just want to hold it for a long time, and with the underlying companies in OMA, I think that's a decent proposition. you're able to defer that capital gains tax for quite a while, and you don't have anything immediately payable. So, it's kind of like a pick your own poison thing. And once again, it all depends on what kind of account you're holding it in. In a taxable account, something like OMA is preferable. If you're in a Roth IRA, maybe JEPI's equity linked notes and the ordinary income is fine for you. But what I would always advise investors to do is to always break down the tax source of the distribution. Of course, before year end, it's mostly estimates. It'll be confirmed at the end of the year, but a lot of fund managers do share these, so take the time to read them.
Adam, what do you think about the tax side?
Yeah, I agree with everything Tony just said. And look, investors need to look under the hood on what they're buying and what they're getting themselves into. I think in terms of the taxes as well as the overall portfolio, just don't buy something because it's called something. And I know we're going to talk about AI later, but that's one of the pet peeves we have in the AI space. You buy an AI ETF and, all of a sudden you see 40% of your exposure is Mag 7. It's like, who the hell who wants that? You've got that. You already own that most likely in something else. So you look under the hood. So on the tax side, yeah, return on capital is the preferred metric for sure, for all the reasons Tony laid out. And, that's what we're looking for. We're trying to maximize that on a monthly basis, and it'll go all over the place. We were at 95, we were at 88, then we went down to 34, but we'll see how we do this month. So, I think over time, we should be in that kind of high 80s, low 90s range, which is kind of, right in the market.
Evan, you want to jump in with any thoughts or questions?
No, I think that is a good thing to look at, and I think the tax areas is something that a lot of people aren't going to dig super deep into, and they definitely should, because it's an important part of this. When you were talking there, Adam, around people buying, that as we head into the distributions, a lot of times you kind of see AUM flowing in. I was curious your thoughts around kind of that, and maybe from a high level of like. That's an interesting concept. Like, obviously, I get the psychology of it, but their strategies. Do you buy it after the distribution? Because obviously stuff happens there. So obviously, I don't want financial advice, but I'm curious your thoughts on like people buy what you're seeing of people adding into the stuff as we head into the distributions.
Yeah, I know it's an interesting phenomenon for sure, because there are different strategies, right? Buy it on the X date, buy it before the X date, buy it on. So, I think it's really up to what the investors are looking to do. It seems like most investors want to get in. If they're convinced that the strategy is doing what it's supposed to be doing, they want to get in and clip off that 125% that we pay. Well, I can't guarantee that. Hopefully we'll pay that, and we'll announce it on Friday. But, this will be the 5th month in a row for OMAH, and our 3rd month for QUSA. So, we call ourselves Target 15, so we better get close to that 15%. So that 125% per month is critical. And people like to get in and clip off that dividend. So we've seen it on every single month. Big inflows leading up to Declaration Day, which is Friday.
Question for you, Tony. When it comes to something like this, we were talking about the flows, and they're really solid. Last month per ETF Central, $98 million worth of flows. Last 3 months, $360 million. There's a lot of ETFs that get launched nowadays. You write a lot about them. You cover many of them. People can look into them on ETF Central. It can be tough to really draw in AUM. Just curious to get your thoughts here on kind of what OMA's done, pulling in so much AUM in this market where, a lot of people are allocated to these growth stocks, right, in other areas. And even as the run-up was starting, it's just been consistent that it's come in. I'm curious, when you look at that, what you think, other ETF managers could take away from that, or just like kind of your overall insights into it.
You got to do something different. Like if active, I see a lot of ETF managers making this mistake. And of course, this is just my opinion. I'm not the strategist running these solutions, but if you're going to launch an active ETF and your active share is below 50%, you're basically just offering someone an index fund with higher fees. And investors can see through that. They might not be able to quantify active share like I can, but they can look at the top holdings and say, I could just buy the Qs for 20 bips and be done with it. And that's a lot of what's happening out there right now. If you look at OMA's holdings, I haven't run the numbers yet, but I can tell you the active share is high. Yes, there's some overlap with the S&P 500, but not in the same proportions or weights. Just have maybe like the 10% Apple is, but having VeriSign and stuff in the top 10 holdings, that tells me there's something different there. And the other thing I see is that with the income, a lot of people have been getting really complex with it. We're talking like bundles of flex options and some people are using futures, other people are using very, very aggressive synthetic cover call strategies. So we're looking at ETFs where they do promise a high distribution, but there's a severe erosion of net asset value because the underlying, and once again, is just a multi-leg option strategy. And I have concerns about the longevity of some of these. So something OMA has done really right is that it comes in with a portfolio that is informed by one of the greatest investors of our time with a very timeless buy and hold mentality. And it just strips out all the other things at Berkshire that someone who's just focused on stock picking doesn't want. If you don't want Geico, if you don't want BNSF, if you don't want the insurance float and all that stuff, well, you just want Berkshire stock picks, this is the only ETF to do it right now. And, it's not proprietary. Anybody can launch something like this, but I've seen like so many launches of leveraged Berkshire strategies, covered call Berkshire strategies. And I'm just thinking like these products are going to die. Like a few of them are barely attracting a few million in inflows. And whereas OMA has really differentiated itself. So I've personally been very impressed. I own a good chunk of Berkshire. I don't own any OMA, but it's on my watch list for sure.
I appreciate that. And I agree on everything you just said. And one thing I will note, which I guess differentiates us to some extent is, and you mentioned it, we're not cowboys on the option strategy. We're not waking up in the morning and saying, let's maximize the gain. Let's maximize the yield. We are looking for 1.25% per month, not 1.26, not 1.24. So when we design, everything we do is data driven. And when we're, putting on our options trades, we're looking to scrape that 125. So, whether the duration is 2 days or 2 weeks, we want to get that 125. And when we hit that 125, we're out of the position. We're not holding the position to try to squeeze out that last bit and maybe have securities called away and if for some reason we do make more money than 125, we're rolling that back into the NAV. We're not paying out more on a monthly basis. So it's a little bit of a different mindset, I think. Maybe a little boring. I like boring. It's just consistent, stable income. That's what we're looking
It's fine. And I think that's how most cover call strategies should be executed. If your focus is on like a sustainable distribution, I see cover call ETFs that will aggressively sell at the money strikes on 100% of their portfolio. And they just forfeit that upside every month. And the most egregious thing is they sell the calls on the exact same date. So it's incredibly easy for anyone to front run. And, predictably, the long-term returns on a total return and a risk-adjusted basis severely lag the uncovered index, right? I think the way to do covered calls is what OMA is doing, selling discretionary on individual names using a data-driven approach that considers things like, changes in delta, gamma, vega. There's so many variables there that you can't just reduce down to let's sell at the money at 100% of the portfolio on the second Friday of the month. And yeah, there are ETFs that do that. I'm not going to name names, but you can find them.
Yeah, agree.
Can I ask why 15%? Is there something like you found different between 10 and 20 or, with 15 in there?
Yeah, I mean, again, maybe in the light that we're a little bit boring, but we go out and actually do a lot of research before we design a product and bring it to market. So we went out and we spoke to a lot of investors and, we tried to determine where is that optimal level of yield. And, again, optimal is different for everybody, but, a lot of the competing products are out there, somewhere between the 8 and the 12% range. We knew we wanted to differentiate ourselves, but you also didn't want to get into the nosebleed area where we're going to have problems with NAV erosion. So, we did all of our analysis, we ran our simulations, and 15% was kind of that sweet spot where we can, differentiate ourselves, give a more robust income stream, but, hopefully avoid that NAV erosion issue when you get into that 25-30% range that a lot of these ETFs are trying to provide.
Yeah, I think there's a strong difference here between constructive and destructive return of capital. And this is something I looked into a lot with closed-ended funds. And the good ones will use tax loss harvesting to, legally classify a substantial portion of the distribution like that. And the bad ones, well, they literally just give your money away. And that's where the NAV erosion comes from. Personally, Adam, like 15 is fine with me. I would have just gone for 12, just to even 1% a month. But like you said, it's splitting hairs at this point.
Yep, I agree. Little bit of a differentiator. That's that from a marketing perspective and, and for an income perspective. I'll take the extra 3 per year.
Well, can I ask you a question actually on that? When you're like, listen, I know the way it works. You see a product at $300 million, maybe even where are we at now? Almost 400.
Yep.
That's yeah. I disrespect you by saying 300. Like this is killing it. So obviously it's what's next. Is it? I'm curious. Is it like, hey, maybe we're targeting a 10% one, or maybe we're doing one with 25 of the holdings or something? Where is your mind going to? Like, there's a success with Buffett here. Is there another person or like entity that you could do that on? Curious where your initial mind's on.
We've got a pretty robust pipeline of products that are, pending. I'm in a quiet period on one of the registration statements, so I can't really speak to it here. But you're going to see some good innovative stuff come out of Vista Shares. And again, anything we do is going to be completely differentiated than what's out there, and it's going to hopefully have a very clear use case for investors.
Tony,
Yeah, so just on that, like it's Oma's novel in that is the first ETF to take Buffett's public securities portfolio. But we've had options-based income ETFs that copy other famous investors. So for instance, I think YieldMax has OARC, which is basically ARC with covered calls using a synthetic strategy. So it's nothing new. The trick is finding an investor with an underlying portfolio that isn't so volatile that you're going to blow yourself up or severely cap yourself selling calls. And a lot of people overlook this, but personally, I think the blue chip basket that Buffett owns is a perfect call selling target. A lot of these are mature companies. They're not too volatile, but there's a liquid options chain where you can steadily scalp consistent premium income month after month after month. And for me, that's more important than selling on something like Nvidia and getting blown out on earnings and getting assigned, right?
Mm-hmm.
Yeah, that's kind of touching on what I was going to ask you there, Tony. But you mentioned, I just want to talk about the underlying here, about Berkshire for a second. You mentioned that this is a big chunk of your portfolio, that you have a good amount of capital invested in it.
Yep.
Is it all the things that you just touched on that are the reasons why? Is there anything in addition to that thesis?
Honestly, it was the most tax efficient compounder I could find aside from Amazon, and there's a $350 billion Treasury bill float that gives me a good built-in margin of safety. You have basically what is a multi-manager fund without the carry and the fees, with a generational mindset and a very robust buy the dip mentality. Like Buffett may have retired as CEO by year end, but he's staying on as chairman. And the rationale behind that is he himself has said that he is the one with the mindset to smell when blood is in the streets and go on a massive buying spree. And with 350 billion, you can outright take Coca-Cola private, or just buy most of the companies in the S&P 500 in cash. And the other thing that I like is that, Berkshire is a source of cheap leverage. That insurance float, the ability to leverage that in a flywheel, only a select handful of companies like Markel and Berkshire, and on the Canadian side, Fairfax Financial can do it. And it's produced outstanding results, because where else are you going to get cheap leverage from with rates these high? You have your own float. Very few insurance companies can do this, because most insurance companies are just good underwriters. They don't also have a master stock picker and a disciplined capital allocator. And these three pillars make Berkshire very special in today's market. The only thing that comes close to me is Markel. And honestly, I'm not really a fan of their venture portfolio.
So I just want to ask the one question, Adam. What happens when Buffett steps down here? He did mention this is his last year as chairman. Do you feel like it removes some of the magic of Berkshire? Does it retain the interest from retail and institutions?
Yeah, I mean, look, Warren Buffett is Warren Buffett. So, having him not involved in the markets would be a huge loss for everybody. But, the reality is that Greg Abel has been at the company for like 20 plus years. There's been a lot of speculation or discussion that he's been running the show day to day for a few years as it is. And certainly he's been steeped in the Buffett philosophy. He's not going to come out and all of a sudden, start flinging, trading stocks all day long. He's a disciple of Buffett, and he knows his process. Doesn't mean he won't come in and want to put a stamp on the company as a new CEO and, make some acquisitions or divestitures that, maybe Buffett, wasn't ready to do. But I don't see a wholesale change in the portfolio strategy, for a long period of time.
Tony, you're not going to sell any of your Berkshire?
No, and I'm preparing for the eventuality that Buffett dies. He's 94. He said himself in a Wall Street interview that he stepped down because his health is faltering and he doesn't have the same lively edge anymore. So it's inevitable. I don't want him to die. Like, he's a great guy and he's just been an absolute institution in the market. But that's the reality. We're seeing that with Berkshire. It's kind of retraced back down. And I think that it's beginning to price in the loss of the Buffett premium. But that's not a bad thing, because here's the thing. Berkshire buys back shares when the book value of the company is around 1.25 times. That's usually when Buffett starts doing it. It's still trading way above that right now. And Buffett himself has said, doesn't matter how you value it, the most accurate barometer of Berkshire's value is its book value. It's still an insurance company. So, in the event that Buffett dies, I expect it to go back down to book value, and the company's just going to start immediately rebuying shares. If Berkshire doesn't see more attractive opportunities in the market right now, but its own stock is trading close to book value as a result of a already anticipated and planned for event, the succession of Buffett after his death, it's a no-brainer. They're going to deploy some of that cash flow to buy back their own shares at 1.25 book, and that's going to be a soft floor for investors. I'm personally ready for that. And there's other ways you can hedge against this too. If you have Berkshire shares of your own, like you could sell like a long dated 1 year covered call, earn a decent premium, bank that, right? And that's hedging against the inevitability that Buffett passes away within the next year. It's quite morbid, but it's a risk. It's disclosed in their 10K, and it's foolhardy to just ignore it and say it's priced in. There's going to be some kind of volatility as a result.
Yeah, I will say, having 325, 326, whatever $billion of cash, also, you can dip into it's a pretty big war chest to buy back your stock for a little bit.
They can't spend all of that though. A lot of that has to be retained to match their liabilities for their insurance underwriting business. But I would say maybe about 50% of it is just deployable. Okay. And remember, Buffett loves being the person during a crisis with both capital and credibility at a time where either is priceless. We've seen this before with Bank of America, with Goldman Sachs, with BNSF. He is in many ways the lender of last resort. And, just to tie in politics to it, I think in a day where Fed independence is increasingly under attack, there's a need for that kind of institution. Who else is going to do it? Jamie Dimon? No, it's going to be Buffett and Berkshire.
Speaking of cash on hand, one quick question for all of y'all, and then we can roll in and talk about some of these other ETFs. I was looking at a post yesterday which was showing money market funds at all-time highs. And it shows that there is so much money still sitting on the side. So this was from a release from ICI.org that total money market funds are right at around, over 7 trillion.
Wow.
At this moment in money market funds sitting on the side, and it's just been continuously moving up. It's a pretty interesting chart that I encourage people to go take a look at if they haven't prior to this. And it just leads me to believe kind of what Evan was saying, which is it doesn't seem like now's the time that all of a sudden everybody's going to start selling, because you have all this institutional money that didn't buy the dip, missed the run up. What, they're now going to start selling the positions at this moment? Adam, how do you look at this?
Yeah, I was just going to mention, was that institutional dollars, or was that a mixture of everything from retail straight to institutional?
I believe that's everything across the board. Yeah.
Yeah, it is surprising. Well, not surprising to your point. Right? There's been a lot of articles written on how the retail investor out traded the professionals over the last 6 months to 12 months. So, yeah, the institutions were probably too conservative, did not get in after the tariff tantrums, and like you said, missed the entire upside. So, I think they're going to have to sit until the next issue happens, because are they going to pile in right now? I'm not sure. But meanwhile, the retail investors have improved their asset values by buying the dip and kind of being patient with the market. So it's good that all that money's there, because it's got to go in the market at some point, which may be the next big leg up.
Yeah, absolutely. Tony, how about you?
I don't buy it. Mostly because Bill Ackman retweeted, and I can't stand the guy. But here's the way I would put it: rates are still high. We're still looking at a Fed funds rate of 4.25 to 4.5. That is a decent hurdle rate. Given that the average investor fails to return that annualized over the long term on a money weighted basis, I think a lot of people are just content to clip 4.2, 4.5% from their money market fund and avoid the froth that is the market. The average person doesn't have stock picking prowess, but they can look at the S&P 500 and see that it's trading at a historically low earnings yield. It's trading at it basically by every metric, large cap US stocks, market cap weighted, are overpriced. And when you put two and two together, well, if I can earn 4.5% risk free in Schwab's money market fund, I'm going to stay there. And if this metric includes institutional, there are a lot of institutions that do have to keep that on hand as a buffer, whether it's for underwriting for insurance companies, whether it's as tier one capital for banks and other lenders. It's there. So personally, I don't read too much into money market fund inflows. You can interpret it either way. When the markets are good, the bulls point at it and say, oh my God, all this dry powder can be deployed. When the market's bearish, they also point at it and say the same thing. So it's just one of those things where I see on Twitter if it pops up on LinkedIn or something, and I just click hide.
Right, but the argument is that you look at Trump's timeline, and every day he's calling for rate cuts, and he's either going to get them from Jerome Powell, or he's going to put a yes man in power who's going to cut rates. And when you cut rates, I mean, money leaves money market funds, right? People are driven to go search for value elsewhere, and so if we get rates cut down to even 3%. What's not to say that $1 trillion is going to come out of those money market funds and enter better opportunities?
I doubt he's going to cut rates. I don't think the U.S. can afford to do that right now. And if it does, well, buy ARK. Yes, it very well could. Or it can go into other fixed income alternatives. People might shift in long duration. People might shift into structured credit like CLOs. I buy that argument that, yeah, if rates go down, flows will come out of money market. I don't buy that it's going to go into large cap U.S. equities.
Okay.
It wouldn't surprise me, though, like everybody piling into the queues again, given the summer we're seeing. But I, for one, really think that the average American retail investor has learned a bit of something from 2022. And given where we are right now, might look into some more sensible risk-off strategies. But what do I know?
Yeah, money having this 4%, and in many places you can get above 4% rates, just makes things funny with where people will and won't put their money. I saw a very fascinating use case, and then Adam, I want to transition to talk AIS here, where there was a betting market for who is going to be the 2028 Democratic nominee for president. And on the list, it was on one of the markets, they had the guy who just won the nomination for New York City mayor, Mamdani.
Yeah.
And he's not a U.S. born citizen, so he can't even legally be the ultimate nominee. So people are looking at it and going, it's literally free money. When you look at it, the return, if you took it, was 3.9%. So what they're doing is they're having people put money in on a guaranteed win. They're taking that money and putting it into a money market account and making the tiny, tiny spread on a risk-free investment.
Clever.
Well, there's real tail risk in that. Well, obviously, and in this case, maybe not. But, given what I've seen this year already politically, anything and everything is on the table. So, anytime that you see like a guaranteed arbitrage trade, you got to ask yourself, what am I missing? What hasn't been priced in yet? Or am I the sucker here? I have seen way too many funds delivering steady gains and they just blow up. What was the last one? Dynamic Alpha, right? Remarkably consistent volatility trading fund. The name says it all. Dynamic Alpha. I think it was doing like 16% annualized, and then the tail risk event hit, and they folded. Stuff happens like that. So these things are like picking up pennies in front of a steamroller.
Yeah.
I wouldn't do it, but some people like to.
Yeah, if you don't know where the yield's coming from, it's because it's coming from you.
Yeah.
Yeah.
Good quote.
That's I had to learn that one the hard way. Adam, let's shift over to the AI world because it's been absolutely booming. We've been talking about AIS, that is the VistaShares Artificial Intelligence Super Cycle ETF, since it came out. This originally launched back in December. At one point, the drawdown was about 28.5% at that low of April 8th, and it has since rebounded very strong to all-time highs, up 13% in the past year, 18.23% year to date, 46.5% last 3 months. Having a small dip here today with the rest of the market down about 2%, but it's really outperformed for the most part when you look at SPY and other areas, a little bit over 22 million AUM sitting in this right now. What stands out to you about AIS, especially post this big rebound that we've seen and where it is currently?
Well, yeah, I mean, look, when everyone looks at the news around AI, they're seeing hundreds of billions of dollars in CapEx flowing into the space, right? So the question is, where is that money going? It's going into infrastructure plays, because that is where the hyperscalers need to build out capabilities, right? The Metas, the Amazons, the Apples, the Microsofts. Those are not AI plays. One day they will be driven by AI. They'll have AI applications. They'll be driving revenue and profits from them. But right now, what they're doing is they're putting in the infrastructure. And the infrastructure in this case is data centers and semiconductors. So every time a dollar is being invested by Meta into infrastructure, it's going into the picks and shovels. It's going into companies that are building data centers, the companies that are building components of semiconductors. And that's where the profit pools are. And that's going to be the way it is for the next 3 to 5 years in our estimation. So, if you want AI exposure, you want the picks and shovels. You want the companies that are building data centers. So for instance, people may not know that about 30% of the cost of an AI data center is in cooling systems. So who's the leader in cooling systems for AI data centers? It's a company called Vertiv. So, it's names like those. Again, it goes back to the overconcentration, what we talked about with Omaha and QUSA versus the S&P 500. You want names that you don't own. You don't need more Meta or more Amazon, most likely. You have them in your, other index funds and your single stock accounts. You want companies that are driving profits today because of unprecedented investments in the space. And AIS is the AI infrastructure ETF. There is no other fund in the marketplace. And there's a lot of AI funds or funds that call themselves AI. But there's no one else doing what we're doing. And frankly, what makes us different is that we're operator driven. So when I say that, I mean, the people that have designed this fund are not a bunch of smart Wall Street analysts. They're a bunch of smart AI operators. So John McNeil, former president of Tesla, he's vice chairman of General Motors Autonomous Vehicle Division. He's on the board of General Motors. He's an AI guru. Sunny Madra, he's also on our investment committee. He's the president of Grok, GROQ, not K. Grok is one of the centerpieces of Saudi Arabia's entire inference center they're putting down in Saudi Arabia, that humane project they're putting together. They just raised $1.5 billion to do that. So, these are people that understand the supply chains. They understand the companies that are winning and losing. They understand the technologies and where technology is going. So, that's a little bit of a differentiator for us, I think, where we have a nice rules-based core based on, what we call the bill of materials and analyzing the supply chain and finding those picks and shovels. But then we have some really smart operators sitting on top of it, trying to understand the risks and the opportunities and try to identify opportunities before others do, and as well as the risks, and more importantly, the risks, frankly. But the key is that we're not, waking up in the morning again, similar to what we talked about with the option strategy. We're not waking up in the morning and saying, what can we trade today? Let's buy some Palantir. Let's sell this. No, risks and opportunities. How does the core portfolio look like? Have there been market changes in technology among the different companies in our portfolio? Are there new companies coming up that have new technologies that can usurp the market leaders? So these are the things we ask ourselves, and the performance is borne out. I mean, I think the proof is in the pudding there. Performance is performance. It could change overnight, though, so I don't like really talking about it. But I think it's pretty clear where the profits are going and where all those dollars are being spent.
Yeah, I love the talk about the picks and shovels plays. And when you go into it, you've done a ton of research, obviously, with John and Sunny. We've showed it on the show here before, but really you've dug into all of the costs of these major AI companies. You talked about coolant, you talk about other areas, and then finding the companies that provide that. So, one that I know that you're very proud that you guys jumped on, GE Veranova, right? And that one ended up being an absolute ripper. It's one of the best performing stocks over the last few months, of 73.5%, up 66% year to date. Really never even had that big of a dip on this one, and just continues to power up, maybe getting the small dip this week for the first time in a while. Yeah.
One thing I also wanted to add in on this, we've been getting so many headlines recently about, today it was Elon Musk put out a post about how much they said he's going to have 50 million equivalent compute units of the H100, which can be a little confusing. It doesn't mean they're going to spend which if based on H100 prices, that would have been $1.5 trillion of spend. But there was another thing there. They're saying, hey, we're going to be buying a lot of GPUs going forward. Last week on Monday, Mark Zuckerberg said we are going to be spending hundreds of billions of dollars on AI compute to build out data centers to go. So there was that question for a while. People, sometimes it was centered around NVIDIA of like, are these major companies going to continue spending money? Are they going to continue building out these data centers? And there's people trying to predict maybe they're slowing down, but time and time again, these companies have not only told you they're going to continue to do it, they have continuously picked up that amount they're going to spend. Zuckerberg, not only now are they spending hundreds of billion dollars on the AI compute too, they're now throwing out $100 million offers to a bunch of different AI researchers. So yeah, there's just been a lot of real headlines recently about expansion. Like this data center expansion is not slowing down.
Yeah, I think OpenAI Altman just came out with something with the today or yesterday. It was something similar.
Stargate and Oracle. There was a headline. Hey guys, Stargate's not going off to the great start. Next day, no, actually, here this Texas factory is up. We're doubling down in this area and stuff like that. So, anytime we've got some sort of negative headline about this, there's 5 to 10 more telling you why that last one wasn't correct, and all these other build outs.
Well, you just think about it logically. Also, I mean, if you believe that AI is a technology that's going to take hold in the economy globally at some point over the next 10 years, it's an arms race, right? All of these hyperscalers, they have to invest because they have to have the compute to develop the applications that will one day offer value to their consumers. And, if they fall behind, they're going to lose. So it's an arms race. It's nothing short of that. And, barring some massive problem in the global economy that sucks dry all the CapEx spending of these hyperscalers, I don't see it stopping anytime soon.
Yeah, a lot of Elon posts today about the data centers.
Yeah, I just shared a little photo there. Crazy everything that goes into it. Tony, what's your take on this sector? And also maybe if you look at any of the holdings in AIS.
Personally, I don't invest in AI. You guys would laugh if you saw my holdings. I own stuff like Rollins and like Service Corps International. So like pest control and funeral homes. So I'm not really an expert on AI. I won't pretend to be, but I will say AIS is differentiated. You have a lot of foreign companies there, and like I've pretty much, if I see an AI ETF and the top holdings look identical to QQQ, I just dismiss it instinctively. And this was one of the ones that actually made me look twice and think, okay, like I don't understand what the South Korean company is. I'm going to look it up. And then I look it up and it's exactly what Adam described, the whole picks and shovels thing, like cooling systems for AI data centers, right? That is a level of specificity that other ETFs aren't even bothering with. And an example I'd like to point out is I own Fastenal. They make they make industrial fasteners, literal nuts and screws, and nobody ever notices them, but they're so vital to industry. And a lot of the companies in AIS are the same, but for artificial intelligence. So I think for this space right now, given where we are in the AI cycle, you want to own the names that nobody knows about, but are systematically important because their valuations haven't been driven up to insane levels like NVIDIA, like what's that other one? What's that other AI company that's like going through Palantir or something?
I was thinking
Yeah,
yeah.
whole bunch of them. Yeah. So I would rather own the no name, like manufacturer some obscure yet vital component in a different country where just by virtue of not being American, it doesn't have an insane premium assigned to it. That's how I would do it if I was investing in AI. But again, I'm boring. I buy stuff like Waste Management because I see their trucks outside.
And I agree with you. And I'll tell you what, I mean, I will call out NVIDIA because I'm embarrassed. It's actually our number one holding now, which is surprising because it was number 16 60 days ago. So, I mean, we all know NVIDIA took a massive run over the last 60 days. So it's now, 5% of our portfolio. But, NVIDIA is an important company, but it's one component of the supply chain. So it just had a massive run though. So, certainly AI has benefited from it. For sure.
Yeah, that's good active management, though. You let your winners run, right? If NVIDIA naturally from momentum becomes the top part of your portfolio, is what Peter Lynch would say. You don't want to trim that flower.
Right.
Let it do it. Let it do its thing.
Yep. Good point. Yep.
I know we got just a few minutes left. Real quick, Tony, just wanted to get your thoughts on the Wild ETF, and then we'll wrap up with any just general thoughts for retail investors who are continuing to look at this market. Not sure if you've looked at Wild, WILD, before. I really like the concept. I was, very fascinated when Adam explained it to me, how they're looking at all of the double leveraged single stock ETFs on the market, and then look for the ones that have the basically highest AUM, fastest growing, there's a couple criteria, basically fastest growing in AUM and largest move, Adam, was that in the past month?
Largest AUM growth and total AUM. So we score them. They score them based on that. Exactly.
Yeah. And then they pick the top 5, buy the individual stocks, lever those up to 2x. So you have a group of basically the top 5 most popular double leveraged all inside of one ETF.
Not the ETFs, Tony. We don't.
I know you're using swaps.
ETFs.
You're using swaps, which is fine. It's capital efficient. But my thoughts on this: look, cheap beta is always in demand, and the more ways investors have cheap beta, the less likely they are to blow themselves up on like super out of the money options. There's always going to be a percentage of people out there who want enhanced exposure, and they want it to the most liquid names. And your options traditionally have been TQQQ and stuff like that. So just having something more concentrated, there's clearly a demand for it. I'm seeing the inflows coming. Holy wow, yeah, I'm definitely seeing the inflows coming to this one. So if it fulfills a need, this isn't something I personally ever touch, but I'm not really an active trader. So, but in terms of the way it's designed, using swaps, yeah, that's standard leverage ETF playbooks. And in terms of the underlying, it's a lot better than some of the single stock ETFs I've seen. I don't know what Tempest AI is, but the other names are all Mag 7, very familiar, very liquid, big market for them. So the one question though, Adam, what's the counterparty for these swaps? I see Merrick's. I don't know what that is.
Merrick. I don't know what Merrick's is, actually. Let me look on the website. We're using a variety of the big banks for the swaps. So I'm not sure what Merrick's stands for. I should know, but I don't. So I don't want to BS it.
No, it's all good. And that's just, for anybody listening to this, like, don't be alarmed if you see a leverage ETF holding swaps. It's in many ways, it's the most efficient way to get exposure because, most ETFs can't borrow internally like you would on margin.
Exactly. Yeah. So every month we're rotating. So we're rotating based on our scoring system. We're looking, 60% of the score is the fastest growing names, 40% is the largest in terms of AUM, and we'll rotate them. So our next rotation is this Monday, actually. So we'll have some new names in there. And Tony, you mentioned the term earlier, animal spirits. So that's what this is designed. It's a behavioral finance type strategy. Try to go where the money is going, right? So investors are putting their money in these 5 names. Let's buy those 5 names. Let's save investors the pain of picking one name and being wrong. I mean, you could be wrong on 5 as well, but at least you're a little bit of diversification there. And this is what institutions are putting together baskets of high beta names instead of choosing one. And this is how we design Wild.
Awesome, guys. Gotta move to wrap up here, but this was super, super helpful for I think a lot of people. I love the market talk too. Looking forward to doing more of these and just walking through different concepts and understandings. Thank you to the 8,500 people that have tuned in. We appreciate you joining the show. Feel free to watch this afterwards. It'll turn into a replay if you missed any of it. Evan, coming to you first. Any other comments you want to share on this one?
No, it was a fantastic conversation. I appreciate Adam and Tony for coming on. Definitely make sure you're checking out, at least going to the website, thisisshares.com, see what it has, as you can see the logo there. I'd also give a shout out to Tony and ETF Central. Also, I would recommend go on ETF Central and dig into some of these ETFs as well and other products. They have a lot of really fantastic information. So this was a great hour. I love it. I enjoy talking about ETFs and learning about different products and hearing what's going on in the world. So I hope you guys all do as well. And like Gav said, once we close this out, the whole thing turns into a recording. So if there's any parts you missed or want to hear again, it is there.
Yeah, those 2 websites that he mentioned, I've been screen sharing them throughout, so people should have seen them. But yeah, the VistaShares website, vistashares.com, info on all 4 of the ETFs. And then on ETF Central, you can actually create a free profile and create a watch list of all your favorite ETFs and see info on flows and write-ups and all that type of stuff. Tony, any other comments for today?
No, just for listeners out there, manage your risk, size your positions properly. And, hedging might seem like a boomer thing to do, but sometimes half the battle is avoiding the big losses.
Yeah, I agree. I'd add to that I was going to say, stay diversified. Don't, stick to your plan. Don't do anything silly if the market gets rocky. And, just try to keep educating yourself. So I appreciate everyone listening today. It was a lot of fun.
100%. Always keep learning. It helps pay attention. I learn a lot of stuff from you guys on these calls as well, just the way that you think and just you're looking at the market. And you get a lot of great looks behind the scenes as well, just at what's happening with these ETFs and different stocks. That's going to do it for this one. For those who want more content, Evan's about to jump over to our Stocks on Spaces show, which starts here in 1 minute. And then later this evening, I will be, I believe, back on for, I'm going to be doing another space in a little bit here. And then there'll be some more content coming. And then tomorrow, I would be remiss if I didn't mention that it's Tesla earnings. And we are going to cover them live on Spaces. And then we're going to do a live stream with Sawyer and Omar, 2 huge Tesla influencers, right after the earnings call. So big stuff coming tomorrow. Thanks everyone for tuning into this one.